National income accounting involves the study of aggregate income, production, and expenditures within an economy. It illustrates the interconnectedness of production, income generation, and consumption within a circular flow framework. 1. Final goods, products intended for final consumption, such as food and cars. 2. Intermediate goods, inputs used in the production process, like cotton for textiles. 3. Consumer durables, long-lasting goods such as appliances, which are not classified as capital goods. Basic macroeconomic concepts. Economic activities are analyzed using two primary variables. 1. Stock, measured at a specific point in time, like the total capital stock. 2. Flow, measured over a period, such as income or production. Investment is a critical component. 1. Gross investment, the total investment made within an economy. 2. Net investment, gross investment adjusted for depreciation. 3. Depreciation, the annual reduction in asset value due to wear and tear. Circular flow of income. In a simplified economic framework, income circulates between households, who consume goods, and firms, who produce them. National income can be calculated using three approaches. 1. Product method, calculates the total value of production. 2. Expenditure method, focuses on total spending, expressed as GDP equals C plus I plus G plus X minus M. GDP equals C plus I plus G plus X, M. GDP equals C plus I plus G plus X minus M, where CCC, consumption. 3. Investment, triple G, government spending, X minus MX, MX minus M, net exports. 3. Income method, sums all factor incomes, GDP equals W plus A plus P plus interest. GDP equals W plus A plus P plus backslash text interest. GDP equals W plus A plus P plus interest, where WWW, wages, RRR, rents, PPP, profits. Methods of national income calculation. Product or value-added method, national income is calculated by summing the value added by each firm. Value added equals gross output minus intermediate consumption backslash text. Value added equals backslash text gross output backslash text intermediate consumption. Value added equals gross output minus intermediate consumption. Expenditure method, GDP is determined as the total spending on final goods. GDP equals C plus I plus G plus X minus M backslash text. GDP equals C plus I plus G plus X, M. GDP equals C plus I plus G plus X minus M. Income method, national income is the total of factor incomes. GDP equals W plus A plus P plus interest backslash text. GDP equals W plus A plus P plus backslash text interest. GDP equals W plus A plus P plus interest. Key national income measures. 1. Gross domestic product, GDP, the total value of goods and services produced within a country. 2. Gross national product, GNP, GDP adjusted for net factor income from abroad. 3. Net national product, NNP, GNP reduced by depreciation. 4. National income, NI, NNP at factored cost, calculated as NNP minus indirect taxes plus subsidies backslash text NNP, backslash text indirect taxes, plus backslash text subsidies. NNP minus indirect taxes plus subsidies. 5. Personal income, PI, national income minus corporate taxes and undistributed profits, plus transfer payments. 6. Personal disposable income, PDI, PI after deducting personal taxes. Price indices and real versus nominal GDP. 1. GDP deflator, tracks price level changes and is calculated as GDP deflator equals nominal real GDP times 100 backslash text. GDP deflator equals backslash frac backslash text nominal GDP backslash text real GDP backslash times 100. GDP deflator equals real nominal GDP times 100. 1. Consumer Price Index, CPI, measures price changes for a basket of goods consumed by households. GDP and welfare. GDP is a useful but imperfect indicator of economic welfare. Its limitations include 1. Income inequality. Rising GDP does not guarantee equitable distribution of wealth. 2. Exclusion of non-monetary activities. Contributions like domestic work remain unaccounted for. Real GDP, which adjusts for inflation, is often preferred for welfare comparisons. Summary of concepts. National income accounting provides insights into an economy's functioning through measures like GDP, GNP, NNP, and PI. Methods like product, income, and expenditure approaches, combined with price indices like GDP deflator and CPI, offer a comprehensive picture of economic performance and welfare.